Small caps not immune to today's sell-off, the Russell 2000 dropping 2%, but managing to post a smaller loss than the Nasdaq and the S&P 500. The small cap index still outperforming its larger peers over the past month, up 8% in that time as investors rotate out of mega cap stocks. Our next guest thinks the group is poised for a more durable rebound. Mike Rohde is Vice President, Senior Investment Director at American Century Investments. Mike, great to have you with us. We talk about small caps like a monolith, but they're really very different in terms of whether or not some are profitable and others aren't. So in different sectors, where are you looking within small caps?
Yeah, I'd say from the asset class as a whole, what you have today is an inexpensive asset class trading below its average valuation over the last 20 years. The spread between large caps and small caps is the widest it's been in decades. The ownership in the market is nearing all-time lows as well. But what you have are some great growth drivers, some fundamental growth drivers over the next, I think, 5 to 10 years that are going to drive earnings growth higher. Consensus estimates are expecting earnings growth for small caps to be higher than large caps for next year. You're also going to benefit from a steepening yield curve. And then finally, reshoring, I think, is a great driver of earnings growth for the next, again, 5 to 10 years. We're seeing it here. I'm coming to you from Kansas City. There's a small town called DeSoto, Kansas, about 30 minutes from here. And they're building a $4 billion Panasonic electric vehicle battery facility. It's going to employ 4,000 workers and really change the landscape of this small Kansas town. And this is happening all over the country. So yes, it's going to benefit the companies that are selling equipment into the building, but also the companies that are building restaurants and housing, banks that are lending into that community. So there's really a multiplier effect from this reshoring trend. And I think that's going to help drive small cap growth over the next 5 to 10 years.
Mike, it's Karen. Let me ask you something. There's been a lot made of this shift to passive investing over the last few years. And the IWM, by its nature, needs to be a little more actively managed to really get to some of the most interesting stocks in there. Do you feel like there's any shift back?
You know what? I think so. There should be. If you look at active versus passive performance, active managers have by far the highest success rate of beating the Russell 2000 or their benchmark net of fees, because, as you mentioned, small caps are a little bit like the Wild West. It's highly inefficient. There's an average of 6 sell-side analysts per stock versus Google or Apple that have 75 and millions of eyeballs on those companies. So, a good active manager can identify when there's a change before the rest of the market and capitalize on that. The index also there's a lot of money losing companies as well. There's about a quarter of the Russell 2000 that are not profitable today. Now, about half of that is biotech, which I'm happy to talk about because I think that's an area where we see a lot of alpha generation opportunities, which you guys were just talking about. But yeah, a good active manager should help you as an investor avoid the money losing companies where the risk is permanent loss of capital. And again, over time, active management has really worked in small caps. So there should be, and hopefully there will be, a shift into active because I think it really makes a lot of sense.